We invest in early stage technology companies here in the Midwest. There are different stages of funding, so it depends on where you're at with the company. Yes, when we launched the fund, we took a look at the region, and we know, as I mentioned before, there is a funding gap. My company is developing a solution that solves a problem that targets this audience with this secret sauce. If you ask for capital, you're going to get advice. If you ask for advice, you're going to get capital.
Wow, that is super interesting.
Build relationships now, early in your life. Those will be super important for whatever you do. We're focused on companies and founders based in the Midwest. Technology is great. It's a good way to maintain relationships, to meet new people, but you still have to, FaceTime is still important. So at early stage investments, the team is probably the most important. There's the old adage, do you bet on the horse or the jockey? A B idea with an A team is usually better than a B team with an A idea. I wouldn't just invest because you know the person, even if it's a friend or a family member.
All right, guys, welcome to another episode of RedNote Podcast. And before we start, I just want to do a quick reminder that we publish each second Monday at 7 a.m. so you can kickstart your week with some advices from our guests. And today, with no hesitation, I would like to present you to Jason Jacobsohn. How are you, Jason?
Great, glad to be here.
Thank you for coming in. So for those who might not know you, I would like to ask you, what do you actually do? And going a little bit further, how did you end up in venture investments?
Yeah, happy to. So I've been in the Midwest my entire life, been on the front lines supporting entrepreneurs and investors, and found myself helping entrepreneurs raise capital, connecting them to resources, and providing general advisory services. So all the things I did led me to where I am at today, which is managing a venture capital fund, Propellant Ventures. We invest in early stage technology companies here in the Midwest. So we have a funding gap in our region, and so we bring in some of the earlier stage professional capital for the startups that need it. So we're filling a gap in our market.
I see. So, and I would like to ask you, for those, we have a lot of viewers who are not familiar with venture investments, and I hear a lot, like pre-seed round, seed round.
Mm-hmm.
And can you actually explain us a little bit more?
Yeah, there are different stages of funding, so it depends on where you're at with the company. Generally, you start with bootstrapping, so you put your own money into it, then friends and family. Maybe tough to get friends and family money, but that's typically the earliest stages. Then you look for angel investors or high net worth individuals, and these are accredited investors, people that have the financial wherewithal to invest in startups. After that, then you go more the professional route and you look for venture capital investors where they're investing out of a fund. Angel investors invest their own capital. Venture capital invests out of a fund. And then there's different stages of venture capital depending on where you're at with your business.
All right. I see. So basically how I see that, you are, as you mentioned, angel investors, that like a private, people who are being by themselves. They have like, let's say, some money, some cash, some liquid, and they're willing to give you those money with some sort of like agreement that when you get to that stage, you will contribute back. Am I right?
So depending on whatever investor you have, whether it's angel or a venture capitalist, they're going to expect a return.
Mm-hmm.
So you're going to give up a piece of your business for that capital, but they're going to expect some type of return. And, it's high risk, high reward, but they're anticipating to get their money back and money on top of that. But you sign agreements, and it can take a while for that to happen, but there's legal agreements in place.
I see. And what's usually the average, I would say, like time to expect those returns to come back?
Yeah, so it depends on what stage you get into. If you're there in the very earliest stages, angel investor, early VC, it could be 5 to 7 years, maybe longer. And if you come in later, maybe it's 3 to 4 years. So let's just say 5 to 8 years is probably a good number, regardless of when you come in. But some investors come right at the end, and then they only have a couple years to wait.
I see. Well, so, and I know that at Propellant Ventures, so you guys, what kind of companies do you invest in? What's that, like maybe niche or maybe some certain like let's say some I don't know, AI startups, or maybe some sort of that type of.
Sure. Yeah, so when we launched the fund, we took a look at the region, and we know, as I mentioned before, there is a funding gap. So we're focused on companies and founders based in the Midwest. But then we also looked at what industries do we have here. We are a very good region with B2B companies, so companies selling to other businesses. We have a lot of old line industries here that are disrupted by innovation and will continue to be disrupted by innovation. So industries we look at, and it's pretty wide, could be financial services or fintech, supply chain, transportation, logistics, education or ed tech, real estate tech or prop tech. We also look at health tech. So we look at a lot of different things, but there's a lot of great industries here that, as I said before, are disrupted by innovation. We have a lot of innovative entrepreneurs. So, but B2B is our focus here in the region. And then we come in earlier than most VCs, as I mentioned. So generally after an angel investment round, we're one of the first VCs that comes into a company.
All right, I see. So as I can hear from you, you're on that stage when you're like 4 or 5 years, maybe 6, like before you get investments back.
Yeah, most likely. Yeah, we're early seed or pre-seed, so that's very early. So yeah, that could be 5, 6, 7 years. Yeah.
I see. And do you have any like successful cases that already kind of like gave you some funds back, or you're just like growing that portfolio and trying to get to it?
Yeah, we haven't had that yet. We're a little early for that, but we have had some unrealized gains. So we've had some companies that have had an increase in value since our investment. So they're, some of them have some conversations about acquisitions, but they haven't been selling yet. They want to create more value. So we're close. I was at another fund before Propellant Ventures. We did have a few exits already, so some returns came back.
I see. And so you mentioned that you worked at a other fund, right? Mm-hmm. So I would like to go a little bit deeper and ask you actually about your experience, because I think a lot of people see you as a like growing investor, successful man, right? But our podcast for young people, and I would like to reveal this backstory a little bit for those who like might wondering, okay, I want to do also like venture investments, or I want to be an investor by myself, but I don't know where to start and how to start. And I would like to ask you, how did you start?
So getting in the venture cap industry is not easy. It's a fairly small industry, even though you may hear about it a lot. It's a pretty small industry, a very relationship-driven industry. So as I mentioned before, I've been involved for over 20 years in the community supporting entrepreneurs. So I know a lot of investors, know a lot of entrepreneurs. And then I also brought the Chicago chapter of the Founder Institute to Chicago, which is a pre-seed technology accelerator. We help people launch companies. So all of that activity that I did, and then I got an introduction to a new fund that was coming to town, and actually based off of my alumni off of my alma mater, University of Wisconsin. So based off of that work and the relationship, I was able to get a position when that fund came into town. So to get in the industry, people have different backgrounds. Some people are entrepreneurs that have had successful exits, so they have operational history. People like to see that. Some are just angel investors that have been making startup investments. Some come from investment banking background. Some are community builders like myself. Mm-hmm. But it's relationships. That's really important. Then some people, they get an MBA from a top-level school, business school, and then that's their way into. So it just depends. But it's not easy to get into it, but relationships are really an important part of it.
All right, so I hear about relationships a lot. We just recently talked to the guy who does compliance and the general counsel at a private equity, and he was telling a lot about soft skills. And what I hear from you is basically the same, right? So we better be focused on, of course, hard skills, super important, but soft skills. And what do you mean by soft skills? Because like what's that about? Is it about like getting more connection, being more friendly? Like acquire those people, get them know well, establish maybe some sort of relationships, or even more like, I don't know, following each other on LinkedIn.
Yeah, I've been doing this for a long time. I started building relationships while I was in college, way before LinkedIn was around. I'm actually one of the first 8,000 users of LinkedIn, so I've been there in the beginning. Now they're at over 1 billion, so it's amazing to see them grow. So, but a lot of it for me was just going to different business events in Chicago and meeting people face to face. Technology is great. It's a good way to maintain relationships, to meet new people, but you still have to, FaceTime is still important. So that was how I started. And then I had a newsletter. I stayed in touch with people. I told people this is what I'm doing. These are events I'm going to. And everything led to, branding myself online, and LinkedIn has gotten much better around that. So I've always found ways to give it forward or pay it forward to help people however I can, and that's how people remember you. So, but again, staying in touch on LinkedIn, doing events. I do a lot of events to bring people together, and so there's a lot of things you can do, but personal branding is super important. You want to be memorable. So there's a lot more tools out there now than there were when I started more than 20 years ago doing this.
I see. Actually, really interesting that you mentioned events, because it's kind of, and also you said a pretty good phrase that I think people should always keep in mind, that the way how people remember you is actually when you do something good for them, right? Yep. So you basically invest first, and then you are getting some investments back.
Yeah, you don't expect anything in return. Help people however you can. They will remember you. So when you are looking for assistance, they shouldn't have a problem helping you.
They're always kind of willing to help you.
Not always, but more willing than they would have if you're just a taker. So it adds goodwill. People have a good impression about you. It's good for your brand, and people want to do business with you.
I see. You think people smell those like takers who are trying to take advantage?
Oh, absolutely. Yeah. It's very obvious when people do that. It's usually people stay away from individuals like that, at least if they get burned 1 or 2 times.
Did you have any experience like that?
Nothing that stands out. There are people that sometimes ask all the time for things. I help where I can, but sometimes they can take advantage of that and never provide anything in return.
Like I do?
No, not at all.
No, I'm just kidding. So, or maybe no. Who knows? So, I have a question actually for you. So, for those people who are trying to be a good investors, and what kind of like, what's the mindset behind? What's the reality, and what kind of mindset should I have to be a successful investor or venture investment?
Yeah, I think it doesn't matter whether it's VC or angel. There are certain things you have to look for, or have to certain kind of temperament or demeanor. You should be patient. These are not going to be quick exits, and you should be ready to lose your money, because especially as an angel investor, so you should not invest money that you can't live without. So expect to lose it. The nice thing about a venture fund is your money is spread out, so the chances of losing it are much harder, because your money is, some companies may go out of business, but you have all these other companies that can still perform. So you have 1 or 2 companies that have a home run, and everyone makes a return. But you have to be patient. You have to also have a good demeanor. If possible, you want to help people, right? So as a venture investor, you should have a network, because you can support your companies that way, whether it's helping them raise additional capital, providing strategic introductions, whatever it may be. So you do need to have a network for this to be successful, at least for your portfolio to want to work with you.
I see. And, I hear a lot from people who are like investors and, angel investors, again, hedge funds, people. So they're talking a lot about framework, establishing the framework, finding some sort of like similarities in market or in companies, and then put that on some sort of like, like basically build the framework and follow the framework. Do you have the framework for yourself?
Well, we do have a due diligence process that we use for all the companies that we evaluate. So that allows us to have a structured process as we're evaluating companies. And we, obviously we put a lot of time and effort into it. And so it's a very well-informed investment decision, whether we make it or do not make it. So, but that's important because we're investing other people's money. We want to make sure we do the best we can with the investments.
And how do you know what kind of companies? Well, so I think it's a lot. I hear that again. It might be a bias, but I hear a lot that it's all about like communication and the way. If you want to like raise the capital, people view you. Let's say I'm a business owner, and people focus all attention on me, the way how I behave, the way how I lead my company. So what I'm thinking about, it's all well. So those are when you kind of make the decision, you usually focus your attention on personality of the owner and how driven is that person. Is that true?
Yeah. So at early stage investments, the team is probably the most important. There's the old adage, do you bet on the horse or the jockey? Most people bet on the jockey because a B idea with an A team is usually better than a B team with an A idea. Now, there's obviously exceptions to all that, but when we come in, the team is so important. So we look for a couple things. If it's a seasoned entrepreneur that's built and sold companies before, that's obviously a positive. Doesn't mean the next company is going to be successful, but you mitigate the risk a lot. So that's one. We also like to see if that founder, if it's first-time founder or a seasoned entrepreneur, do they have domain expertise? Do they understand the industry and the pain point? That's super important. And then we want to see their grit and how motivated they are, their passion, all the drive they have. Entrepreneurs have a vision and they want to make a difference. So, those are things that we look for as well. But the team is super important. If I get a bad vibe or bad feeling about founder, I'm going to move on because this is someone you're going to be dealing with for a long time.
I see. Well, actually, you mentioned, and I watched this podcast about the guy. He's like, I think it's Andreessen Horowitz.
Yeah, Andreessen Horowitz. Yep.
Andreessen Horowitz. Yeah, and so he was saying a lot about like the team and the importance of the team, and it's basically like your team is the core value, like the core of your company when you just started your business. Is that how the works?
Yeah, it's everything. It's a small team. Maybe when we come in, it's usually one or two founders. You're doing a little bit of everything, and so as you bring people on board, whether it's full-time or part-time, they have to fit in the culture of the business, and they have to be resourceful, because if one person is say a bad seed on the team, it's probably not going to work. So everyone is super important at that early stage.
And what are usually main mistakes that investors tend to make when they are like either angel investors or VCs? We all humans, and probably it happens that you make a mistakes, and if you somehow made a mistake that you can share, with us, so we are not gonna, do the same mistake. Do you have any of those in your mind?
Well, let me start with earlier stage or angel investors or friends and family even.
Mm-hmm.
Sometimes people, and rightfully so, they invest in people they know and they want to support, but they may not do the full due diligence on the opportunity, the team, and the company may go out of business. So you want that support early on, but you still should do due diligence and evaluate the opportunity. I wouldn't just invest because you know the person. Even if it's a friend or a family member, again, you want to support that person, but that's a mistake sometimes, but also not fully understanding the opportunity and the growth opportunity and how that if you're going to invest, you want these companies to be able to have potential for growth. So that's one. I've seen those opportunities. People invest in the wrong opportunities because they didn't fully understand the business and where it was going. On the VC side, you just don't. Sometimes you don't know, right? If you're having mixed feelings about it, you probably shouldn't do it. You want to feel 100%, 110% that this is the right opportunity. Sometimes investors invest where there's trends happening, and those. I mean, look what happened in the virtual world when we all went during the pandemic. There are a lot of virtual businesses or virtual event platforms, as an example. Most of those went out of business because once people started going back in person, they had a hard time sustaining a business because people weren't going to just do online. And so we invested in a company in that space, and the market turned on them, and unfortunately, they weren't able to keep the business going. But just the reality of it, there's risks, and sometimes it doesn't work out, and so you just have to. So sometimes investors, if they invest in those trends or short-term opportunities, I'm not saying that's what we did, but sometimes people do that, and it doesn't turn out well. We all the companies we look for, we invest in. We look to see long-term growth opportunities. We're not doing any short-term stuff at all, but the market turned, and it turns on certain industries, so you can't always plan for that.
I see. It's actually a good point. So you're not trying, you're not looking for a short term. It's not your type of
Yeah.
So you're thinking about like long term. You have a long term goals, which I think I hear a lot again. So the market, even the stock market. We're not talking about stock market, but companies also. It's a part of stock market, and it's all about like long term investment until they get to the point where you can get something back.
Yeah, venture investing is all about long-term investment. Sometimes you can come in right before there's an exit. Your return's going to be generally lower, but when you come in as early as we do, and even earlier at angel investors, it's a long-term investment. With the typical venture fund, it's a 10-year hold. You're expecting your return and your money back and a return over 10 years. Now you can get some of that back well before that, but it's a 10-year lifespan because it just takes time for things to develop into exitable companies sometimes.
I see. And what are the key, I would say, lessons that you learned during your, extensive career? What was can you give us maybe 5 key lessons that you got right now in your mind that you can share with us?
Well, one thing we talked about earlier is relationships are everything. My entire career has been built around relationships. I started that freshman year in college, got involved in student organizations, and saw the power of that while I was at school. So when I came to Chicago, I continued doing that. So relationships are key, number one. That's the biggest asset anyone has, and you can take that wherever you are. So take that serious. Another one is be trustworthy, be credible, do what you say you're going to do. If you tell people you're going to do something, do it. Your reputation can turn on you pretty quickly, and people talk. So as I said before, pay it forward, help wherever you can. So that's super important. Have a good demeanor.
Mm-hmm.
Be nice to people. Try not to complain too much, and just be positive. People want to be around positive people. So that's super important. Be resourceful. So as an entrepreneur or just in life, be resourceful. You're going to have to figure things out. So have a good network of people, but also be diligent, be able to figure things out as well, because you can't ask people for everything. I say with ChatGPT, there's a lot more, in AI in general, there's a lot more ways to find information out there and help you do things. Another one is be open to learning. I'm always, one thing about venture investing, you're always learning about new industries. Also, I'm meeting new people, so you're interacting with new personalities, and that's one thing I like about the work I do. Every day is different. And also be approachable. It's super important. That goes with relationship building, but people are going to reach out to you. Respond to them. Obviously, if it's a spam, different story, spam message, but respond to people on LinkedIn, through email. If someone connects you, respond, be approachable. A lot of opportunities have been presented to me in my career because I've been approachable and have taken meetings, or calls, right? So that stuff has been very important for my career, and it's really shaped who I am to this day.
I see. So it's actually a good point. So sometimes people are like, do not understand how valuable it is, and you never know when you get this connection. Who will be that guy who gives you certain knowledge or other connections that may lead you to some beneficial outcome? So I would like to go a little bit further and ask you more like technical questions about the companies. And what kind of companies do you invest in? You mentioned B2B, but what's the industry?
Yeah, so we've made some investments. So we've made investment in a supply chain company. We've made investment in a ed tech business, a fintech business, a prop tech or real estate tech, future of work company. And so those are all B2B. They're all in this region, and they're early stage, but they're supporting other businesses. So in our region, especially in Chicago area, supply chain, logistics are big industries. We have manufacturing's big as well. But yeah, all these businesses that we invested in also had revenue. We like to see a little revenue. Doesn't have to be a lot, but we want to see some initial product market fit. And so that's important for us. We realize that their final product market fit may not be realized till a little bit later, but because companies evolve, but we want to see they've done something before we come in.
I see. So it's not just a blind shot, like.
Yeah, friends and family and angels generally come in to get them to that launch phase. We're very early. We invest with a lot of angels as well, but we like to see some initial proof of concept that they have. Some people have already purchased what they're offering. Doesn't have to be a lot. We don't have a minimum.
I see. So, and you mentioned that you actually do how do you say that word?
Due diligence.
No, I can't. Okay, so you say it. So you're basically trying to find out how company are. You're trying to find the background on them.
Yeah, so we have an extensive process. So we have a scorecard initially that we use every time we have a conversation with someone from the team. We score across a bunch of different areas. So it could be the business model, the team, the go-to-market strategy, their product market fit. We look at all these different things. That just gives us a high level of what we think about the company. Then if we decide to move forward, then we dive deeper into due diligence. We talk to the team. We'll talk to another investor, especially if they have a lead investor. We'll talk to a customer or partner. And we'll put together this extensive report. So it's usually 10 to 12 pages of information. They have a data room, so we look in the data room and look at all their information. We come up with a bunch of questions. We do some of our own market research to validate what they're saying, and then we put this report together. We write this. I mean, with AI, I suppose there's ways to streamline some of this, but we do the research ourselves and put it together, and we have a bunch of questions to fill in the holes. It's almost like a big book report, but it's a well-educated decision before we make that investment. After that, after we put it together and we feel pretty good about it, then we have an investment committee meeting where some of our investors are on the committee. We have one final meeting with, with the CEO, and we have a conversation. Then we make the decision right after that.
That sounds actually about your investors. So you have, so it's not only you. It's pretty obvious that you're not running the fund by yourself, but who are those people? Who are those people who are like behind the scene?
Yeah, so I'm the only general partner, but then we have venture partners, we've got venture advisor, venture fellows, also investment committee. So venture partners have different experience in venture as well as entrepreneurship. They help me strategically. They open up their network also for deals and other opportunities. Venture fellows help with due diligence, and then the investment committee helps me make that final decision. And it's usually made up of our investors in that final decision before we make that investment.
Okay, I see. And when you consider an investment, how do you balance risk and reward? Because we all know that, as you mentioned before, in VC, it's all about like long term, right? So, but at the same time, you definitely have a lot of risk because you're not taking revenue from the company. You're not. I'm assuming you're not, kind of taking the dividends from the company.
No, there's a convertible note structure that could happen, but most people don't want that to happen because they don't usually have money to pay you back. So, but yeah, that's not our goal.
I see. So, but how do you balance risk and reward?
Well, we know that it's risky to invest in startups. That's the one nice thing about a venture fund. You have a portfolio. So your money, every investor's money is spread out across every company. So there's not a huge amount in any particular company. So that is one way to mitigate risk. But also one thing we talked about earlier is making sure we're confident with the team. And the due diligence is super important. That can mitigate the risk too, that we have a well-educated decision before we make that. But the team is super important. We have to feel comfortable about the team. But having the venture portfolio, as I said before, money is spread out across all the companies, so that mitigates the risk significantly. If you just invest your money in one company or two companies, and they go out, one of those companies goes out of business, you're losing all your money. So that's the risk as an angel investor, that if you should spread your money out, but if you just invest in one company goes out of business, you're going to lose everything. So you have to be careful about that. And that's the benefits of venture, but there's other ways to invest also.
Well, as I can tell, it's pretty risky because even if you have 20 companies and you invested in 20 companies, and let's say two of them go out of the business, it's like, what was that, like 10%? Yeah, you're losing 10% of your capital. And I have a question. So why, it's a little bit like random, but why did you decide to be in VC? Because let's say there is like a private equity, like a leveraged buyout, where you're doing leveraged buyout, where you're basically like taking money from a bank and you're buying those companies. Or let's say there is a hedge fund, or it's like a lot of other funds that are less risky. And why did you want to be in VC and not in a hedge fund or private equity?
Yeah, that's what I know the best. I've spent probably close to 25 years now supporting entrepreneurs, and relationships are a big part of that. I realized that I could support them by connecting them to resources, whether it's investors or other people that can be helpful. So it's the exposure I had in the industry, and realized that I can support them at the earliest stages. And so that's really where I found myself in the business community, mostly with the entrepreneurs. While I have a finance degree, I didn't go the traditional route where I was doing heavy financial analysis. I started my career in real estate and did some of that, but then I decided I wanted to get away from a computer and go out and meet people, and that's what really helped me gravitate towards where I am today. And helping entrepreneurs raise capital is something I've done, and then being able to invest in them was the next level for me to support entrepreneurs with all the work I've done over the years. So that made a lot of sense for me. Private equity is much bigger dollars, a lot more financial analysis and all the things that go with it, because these are established companies. I felt I could be most helpful at the earliest stages just because I've spent so much time in the space. So to me, you're getting to meet the founders, helping them. And to me, you're right there at the beginning or close to the beginning with them and seeing their growth and hopefully making an impact with support that you provide them.
Yeah, that sounds fascinating, being honest, because people are always saying that private equity hedge fund, it's like soulless. It doesn't have any soul. Those people are like basically money for money. But here I can see the story and I can see the background and I can see actually the goal. What's the end goal? Help those people raise the money. And I know that you're basically like advisor also for those people. You are advising them along their journey, because so a lot of those people you're investing in, they may not be established business owners, entrepreneurs who have a lot of background. Of course, it's always good to invest in a guy who, I don't know, sold the startup for 1 billion, working in Meta, Google, and then, all of a sudden he decided to start one more company. But it's, especially here in Midwest, a lot of people, it's again my opinion, when I hear venture capital, I think about Silicon Valley, I think about all those like companies that reach their billions of dollars in market cap. But we tend to forget about those like smaller regions, I would say, like a Midwest again. So it's a lot of opportunities here. And I just want to say thank you that you are doing that, because, if I was that guy who had the company and I was looking for, some sort of funds, I would definitely like try to find people like you and come and, well, not necessarily try to raise money from you, but I think you do a lot of advices. So like, as you mentioned, you have your networking kind of like events. And I hear I saw you a lot on LinkedIn. You're posting this. Today we have event. Join us, guys. It's absolutely for free. Which is actually, I'm. Can you like briefly tell about those events? How people can find you, where to find you? Of course, all links on your resources will be down below in description. So if you want to follow Jason, you can just go down and do that. But Jason, tell us a little bit more. How that happens.
Yeah. So as I mentioned before, I'm a ecosystem builder, and I've been doing events for 20 years. So every month there's some event happening. So almost every month I do an event called Founder Night Out. Now it's branded with Founder Institute, but this is just a community event. It brings founders, aspiring entrepreneurs, investors, and other people together. We do it about once a month. So you can find that on LinkedIn. You can find it we have a meetup group, Chicago Startup Founder 101. So those happen regularly. We also do virtual discussions. We're doing a pitch event in a couple of weeks as well, where entrepreneurs can present basically a 1-minute pitch to get feedback. Then I also hold virtual discussions on different topics that are highly curated for Propellant Ventures. So we have investors and entrepreneurs on those, and we've started posting those publicly as well, and you can find that on LinkedIn mostly, if you connect with me on LinkedIn. If anyone connects with me on LinkedIn, make sure you told me how you heard about me, because I don't accept every invitation, but I respond, and just tell me how you've heard of me. And I've built a pretty good network on LinkedIn, but you've got to qualify when you're reaching out to someone if you don't know them. And I'm happy to share information with you if you ask for it, but you can also find it on LinkedIn. So for me, it's just bringing good people together, and it's also a way for me to build my network and also continue to build the relationships I already have, because a lot of the guests are people I know.
I see. And let's say I'm like, let's say I don't have a business, right? But I want to go and meet you guys. Is it possible? Are you okay, like talking to those people who do not have necessarily have their company, but maybe thinking about that, or maybe they're like on their early stage, they have like some sort of startup, but it's not even like MVP. So is it okay if I come to one of those events?
Of course, we have a lot of people like that at our events. So we have people are thinking about they were a company or maybe they have multiple ideas. So absolutely.
And what kind of event is that? Is it like how can it? Well, so basically, I just walk in and I kind of networking with you guys. And what's the location? Where all
Yeah,
that?
so we typically do it at Moe's River North in Chicago, and it's pretty just a happy hour. There's no agenda. We do it for a few hours. You come and go as you please, and they always reserve an area for us, and that's pretty much it. There people may order drinks, they may order their own food, but we keep it very casual, and we do it just about every month. And they know us there. They support us. They're easy to work with. And we get all kinds of people. So we get sometimes we have students, we have aspiring entrepreneurs, those have already launched companies. We have also some of our graduates of Founder Institute there, some of our incoming founders, we have some of our mentors there. So it's a wide mix of people, but it's very casual. And anyone can go. You don't have to be an entrepreneur. So
That's that's really good opportunity, I would say, for those young people. All right, guys, I just want to do a quick reminder that this podcast has only one sponsor, lifetime sponsor, and it's my agency, Bace Agency, where we're dedicated to deliver the best service to our clients. So if you're looking for software solutions such as websites, CRM systems, backend, or some sort of like APIs, you always can go to us. Or if you're looking for design, your brand books, logos, or just a simple, designs of your some sort of posters, it's always, and we know how to combine business, technology, and creativity in our solutions. So let's keep it going. And well, let's say I have my startup, I have a small team, and how can I acquire those funds? What are like key strategies or maybe the framework that I should establish, and how should I, let's say, market myself for people like you? So
well, not every company is fundable. Let's start with that. Now, you can probably get friends and family money because your friends and family want to support you. Once you look for professional investors, and not every company is fundable, but if you are going down that path, it's relationships. That's critical. Get introductions. Talk to people what you're doing. Ask for introductions. So if you're looking for angel investors, those are not as known. They're not out there as much. They don't necessarily have a website, but you can find them on LinkedIn. But ask people you work with, attorneys, bankers, accountants. People know people, so that you've got to ask for those introductions. A warm introduction is better than reaching out to someone cold. Now, sometimes those work, but it's much better with a warm introduction. And depending on where you're at, there's also angel investment groups, and that's a group of investors that come together to look at deals collectively. So maybe you get one, maybe you get two, maybe you get the whole group to invest, but it's your way to get in front of a bunch of people at once. You still need to have a relationship. You can apply, but through certain systems, but it's still better to have a relationship. When it comes to VCs, same thing. Warm introductions are the best. Most of their information is online, but you still want to get that introduction.
It's a great point. So warm introduction. You better know the person who knows that person.
Yeah, find a super connector. Find someone that knows a lot of people that you get to meet, and that person hopefully can make an introduction. That way you don't have to meet a ton of people, but you need to meet the key people. As an entrepreneur, you're busy building your company, so you don't have a lot of time to do that, but it's important. So if you have a co-founder, which I recommend having co-founders, one of you can spend more time on capital raising, the other one can spend more time on building the business. Also, depending on where you're at, there are accelerators like 500 Global, Techstars, Y Combinator, three of the biggest that are funding accelerators. If you get in, which is very difficult, capital is provided, and then you have access to investors as well. So,
Well, so I would like it might be a little bit harsh, but I just want to say that a lot of people, let's be honest, a lot of people have their ideas. A lot of people are trying to build something. It it doesn't mean that if that's your first try, it will be like successful. You will be successful. Even your second try, third, fourth, fifth, it doesn't mean that you will be successful. After all those tries, you may fail, and it's okay. And I just want to tell people that it's okay to fail because a lot of people are expecting, they're living their dreams, and this market, American market, is really competitive. It's a lot of opportunities here, but at the same time, the competitiveness of this market is extremely high. So, based on those factors, how can I stand out?
well, as you said before, failure is part of the process. All the, we'll call celebrity CEOs, people we know about, Steve Jobs, Jeff Bezos, Bill Gates, all these individuals had failures along the way. We just hear about their successes. And so it's fine. If you fail, you learn from it. It's a rite of passage. Certain parts of the country, failure is seen more favorable than other parts of the country. So failure is fine, and you learn from it. Also, not every business needs to raise capital. If you can build a business that can sustain itself with revenue, that's the best form of capital. So it really depends. It doesn't have to be a high growth tech business. It could be a service business, it could be a product business, it could be a lifestyle business where you have a nice business, you nice paycheck, you hire some people, but you're not growing super high like investors expect if you raise that kind of capital. Again, if you don't need to raise money, don't raise it. It's okay to not do that, and revenue is the best form either way.
So, if you can grow without raising the money and you can do that naturally, do as far as as much as you can, get as much as you
Yeah.
can, because if you allocate those investments, you will sell the share of your company, right?
Yeah, at some point, so it depends on where you want to go. There are many businesses that have organically grown through their own revenue, put their own little capital in it, and maybe after 5, 6, 7 years, they decide they want to grow to another level. Maybe they have a different market or a different product. Then they decide to raise capital. At that point, the company's going to be a lot decently, pretty high valued, potentially, right? And then the founder doesn't necessarily need to give up as much of the business. So at that point, if you have a like Google had a successful business before they went public, Facebook did too. Now I know they both had investors, but they were pressured to go public because their investors wanted a return. Most companies don't go public. It doesn't happen a lot, but grow as far as you can until you absolutely have to raise money. And it could be in the first couple of years, that's fine, but the more value you can provide about your business, the better you are going to be when you raise capital.
How do I know when I get to that stage where I have to raise the capital?
So it depends. So it could be your expenses are just getting too high and you want to get ahead of that because you need to continue to grow the business. That could be one. You may need capital to continue to build your product or maybe launch a new product. You need capital for marketing expenses. If it's a consumer business, marketing's expensive. So you need capital to bring in marketing and potentially sales resources. You'll know once you have a short runway when you're running out of cash and you don't see the visibility to getting more revenue. So you should be looking for capital at least 6 months before you need it. But you'll know usually that you're struggling with your expenses and you're not able to grow the way you want to grow. And you just may want to build something new or add on to what you built.
And getting back to founders, how do I pitch? What are you what you as an VC, what are you guys looking for when you listen to those 1 minute pitches? What are like?
Well, yeah, so there's different stages. If you can get someone excited in 1 minute, that's a good thing. Your goal is to get someone to want to have the next meeting, whether it's 1 minute or a pitch deck. But in 1 minute, you want to clearly articulate the problem you've identified. Your solution needs to be pretty clear. You need to talk about your background, why you are the right person or the right team to execute on this, and even some of the differentiator of why you're better than what's already out there. And if you can, start with a story. You know, this is your why you're starting this. Maybe you were impacted by this problem, or maybe someone you know, and you're creating a solution to solve that problem. And if you can do it, also have an ask. It doesn't have to be capital. It could be looking for a co-founder, a CTO, a partner, a customer. It's a lot in a minute, but when I do guide entrepreneurs on 1 minute pitches, there's a framework that I share with them to help them get it to 1 minute. So with Founder Institute or other programs I'm involved in, we time them to make sure they're done in a minute. It goes by very fast, but every word matters in 1 minute, so you want to be very effective. There are pitch competitions out there that only give you a certain amount of time. So your goal is to get that next meeting. You want to say just enough to get someone excited to ask a question, but also want to have another meeting.
Can you share that framework with us that you mentioned?
Yeah, so my company is developing a solution that solves a problem that targets this audience with this secret sauce. And then you can expand on why you, why now, and what is your ask. So if there's something in the industry, like whether it's government regulation, there's a growth in the industry, some new trend, even though I don't like trend investing, but there's something new happening, that could be the why now. Why you can be your background, if you've done this before, if you have industry experience, that's important. And then the ask is always important because you don't know who you're going to be talking to. It does not have to be capital. Usually you shouldn't be asking for capital at this early stage. Ask for something else. So as I mentioned before, a co-founder, a CTO, a partner, a mentor. And there's an adage in the industry, if you ask for capital, you're going to get advice. If you ask for advice, you're going to get capital. It's better to go in asking for advice because you want to lean on someone's guidance. And if that person likes what you're doing, then maybe capital comes later.
Wow, that is super interesting. So how I see that, so you're basically marketing yourself. So you have this, let's say, a problem that you're trying to solve. Then you season that with your personal story. And what you mentioned, I think, is so crucial. Ask for advice. And then if the person likes you, they will invest, that is.
Potentially, right? But you're not, there's less pressure on that person. People don't want to be pitched all the time, but if you ask for guidance, most people want to help. So, and your story is, the hook is important. So if you have if it's a story, emotional hook is important. Anything to get people to want to listen to you more. So when you do a longer pitch with a pitch deck, especially it's a verbal pitch, right? You want to have that hook. So emotions definitely get people to want to listen, or just, whatever that personal story is. So
That is, I think it's really valuable because I'm kind of trying to educate myself in that field, but I never heard about that. And I think it would be so valuable for our viewers, especially for those who are trying to raise a capital, build their companies. And I would like to move forward and ask you more like a general questions from perspective of just like just a common person. I don't have, let's say, I don't have my company, but I somehow saved, let's say, from 5,000 to 2,000, and I'm looking to invest. And how can I invest those money? Because it's, generally speaking, well, 10,000, respectfully, not a big money at all. And do I better invest them in S&P 500 or some individual stocks, or maybe I try to find those companies and somehow be the angel investor, or I should come to you and give my money to you?
Well, first of all, if you're investing in startups or a fund, you want to be an accredited investor, and I'll explain what that is.
Okay.
So you need to have a household income, or say an individual income of $200,000 or more for a 2-year period, or a household income of $300,000 or more. So if you're a couple, you'd have at least $300,000, or you need to have $1 million net worth, which does not include the value of your home. That's what an accredited investor is. It's been like that for decades. It's a low bar for a lot of people, especially if they're seasoned executives or been in business for a long time. So even as a company, you want to make sure you're raising mostly from accredited. Now, there are some exceptions, but accredited is always better. So with that, most young people probably are not at that level unless they have family money, a trust fund or something where they're able to do that, or maybe they've had successful exit, they had started a company. So if you have, say, $5,000 to $10,000, if you do want to get into angel investing, there's crowdfunding. So you could put a little bit of money into that, and because you don't need to be accredited for that, so you could put a little bit of money into that. That's one way to do it. Some companies will take some unaccredited investors or non-accredited investors. You could potentially do a little bit there, but I would spread the money out. If you're going to do it, say you have $10,000, maybe do $2,000 across 5 companies. So you're spreading your risk. So that's one way to do it. There are some funds that have a funding element where you can invest alongside the fund. So that's one aspect or avenue. I recommend, though, as a young person, if they're not doing it, to save a little bit of money every month, put it in an IRA, because you look at the compounding interest rate of money, sooner is better. I learned to do that my freshman year in college. My professor said, just save a little bit every month. By the time I'm 30, it'll be significantly up there. So that should be done no matter what. Something should be saved every month. But I would recommend diversification. So, sure, you could invest directly in a stock. $5,000 may not get you that much, depending on what it is. So, but you can invest in a stock that, maybe a penny stock or something that has a lower entry point. I know people have made a lot of money off of Tesla, for example. It's gone up and down, right? But they came in early and they made a ton of money. So if you can find a company like that early on that has the potential for growth, could be an opportunity. The good thing is, though, it's public markets. So, obviously you can still lose money, but you can also keep it in there and hopefully get your money back if it happens to go down. But diversification, I think, is important either way.
So you're not just betting on one company, right?
Right. That's my advice. That's why I'm very bullish on venture. But even if you just want to be an angel investor directly into companies, I would spread it out just to get started. Just in the beginning, as you have more capital, you can put more money into one company. But if you only have $10,000, spread it across 5 companies.
And can you briefly explain what is IRA? Because I think a lot of young people have no.
Yeah, it's investment retirement account. So basically, you can't take the money out until you're 59 and a half, but the money is invested in mutual funds. So someone manages it for you. But if you put a little bit of money every month, and by the time you're at that age, you should have a good amount of money for your retirement. So it's just supporting you for when you do retire. I know not everyone retires these days, but that's in those investments are till 59 and a half. So it's just the fact, just even if it's $50 a month, $100 a month, that adds up a lot. So it's recommended that to do something like that, or whatever, or if you do a different type of account, but have some money saved every month.
Well, and why don't I just go and invest by myself those 50, 100 a month? Why should I put them in IRA?
Well, because you're saving for your future. So it's just like a 401k, but you're doing it on your own. And so you're just saving for your future. you should diversify. You can do some riskier investments. So I know people use Robinhood and other robo traders. So you could do stuff like that, right? But you also want to have something that's for the long term for you that you're just letting sit there, basically. So I recommend doing multiple strategies if you can.
So I'm basically locking up locking my money.
Yeah, you are. And again, maybe that's an old thing that people do, but I still think it's important to save some money every month. So you are locking your money in, but if you have a 401k at your company, you're locking your money in also. And so you should try to contribute to that as well. Again, you want to secure your financial future. So by doing those types of investments at a minimum, right? But you obviously want to try to earn more money, and maybe you earn some of that through riskier investments, obviously through your income, but guaranteeing that some of that money, but that's the thing, time value of money, it grows over time. You let it sit there and it's growing over time. Some people obviously, want to maybe put it in other things to have a higher return, but I recommend doing multiple things.
Yeah, actually about higher return, a lot of young people are chasing this dream about crypto and all that stuff and trying to make as much as you can. But do you think it does make sense? Does it make sense?
I mean, crypto, you can do fractional shares. I've done a little of that, but crypto is meant to be a utility where you could actually use it to purchase things. It's become more of an investment vehicle at this point. There's a lot of ups and downs. It's definitely volatile. I wouldn't put all your money in that, but maybe if you want to diversify, but there's other current cryptocurrency that you could, or other, ones you could invest. It doesn't have to just be Bitcoin, right? That's the one I'm thinking of, right? And Bitcoin is what everyone thinks about, but you can but some of them do have utilities, right? Bitcoin is the one that doesn't have as much of a utility. It's more of an investment vehicle, but again, diversify. If you're going to do it, don't put all your money in that.
I see. Well, yeah, you broke a lot of hearts of young people. Well, but yeah, so if you, let's say, if you invested, it's not again, guys, not a financial advice, but if you would you recommend invest in S&P 500 maybe, or Dow Jones, or maybe Bitcoin, or maybe Ethereum, whatever? What do you have?
Well, if you want to invest in the stock market, I think that makes sense. Not everyone invests in the stock market, but again, I go back to diversification. If you want to have some relatively stable or less risky investments, S&P 500, you can do a mutual fund. Maybe you invest directly in some stocks. And again, you probably let that sit for a while. But that's not a bad strategy, but maybe that's what you do now until you have more income or wealth creation to invest in other things. But I wouldn't just invest in crypto, for example. I did it a little while ago. I haven't done it in a while because some of those went out of business. And so diversify, but crypto, it's not a get rich quick scheme like some people may think. Now, people made good money off that over time, but they got in early too. It's pretty expensive now, so but it's still risky.
So they basically were VCs for Bitcoin. They're like angel investor for Bitcoin. You know what I mean?
Yeah, I mean some people, people in Silicon Valley knew about it and they got in. Some people got in pretty early and have made a good amount of money off of it.
And so, do you think crypto is a bubble?
I mean, it probably was already in that. I mean, people say, crypto winter, right? Where there was it was not doing well. It's still volatile. I mean, it's not backed by currency or anything like that. It's still up and down. So I don't know if bubble's the right word. I mean, maybe there was, it goes so up and down. I mean, it was really high, then it went down. Now it's gone way up, right? So I don't think it's a bubble. I think it's just a very volatile currency. I mean, a bubble to me is where things crash, and like we had the .com bubble, in the late 90s, early 2000s. So, yeah, but crypto is something that's going to be there. I don't think it's going away.
So, and what do you think about those people, those crazy people? Like, there is a company, MicroStrategy, that is investing in Bitcoin, like a lot of money. They have a couple billions, I think so.
Right now they're doing that?
Yes.
Well, they're betting on it's going to keep on going up. I mean, it'll probably be at 100,000 a Bitcoin probably pretty soon. I think it's around 76,000 right now. Yeah, they're betting on it continuing to go up. So, yeah, that's where people hope it goes.
Yeah, but it's not always like that.
No, it'll go down again. It goes, but they're probably doing that for the long term.
Oh yeah, they definitely do this for a long
Yeah.
time. I think when you invest that much money, and especially I know, well, so kind of policies are getting closer to the crypto and
Yeah.
all that, and they're trying to establish. I heard this news about like some sort of like a fund that they're trying to create some sort of like a fund that will allocate a lot of that crypto. So we're getting there, but I still think, and as I can tell, what you're saying, that it's a long journey. And on your website, I saw that you're actually kind of aiming to get to some certain amount of companies,
Yeah, 20 to 25.
20 to 25. Why is 20 to 25?
Well, that help. Part of it's looking at assuming depending on how much we raise, that's part of it, but also it builds a diversified portfolio when you have that amount. So gives you more opportunities for greater success with some of the companies.
And is that true if that it is better have a lot of funds than, well, so what I'm trying to say that I have a friend of mine and he's like really established in finance, and he was telling me the story how he had tried to build a hedge fund or private equity. I don't really remember,
Mm-hmm.
and they came up with a strategy, and but they needed like, let's say, 20 million to raise to get the strategy moving. So is that the case for venture capital?
Well, obviously, the more capital you raise, the more companies you can invest in, right? And so you're creating a diversified portfolio. So that helps. You don't have to raise $100 million to be successful in venture. You could raise 10 million. You could raise 5 million potentially. It really depends on the companies that you pick. But the more you have, the more chance for success. Because you're going to have some go out of business, some that break even, some that may have a 2x return. But you want one that maybe has a 100x return. So that's why more companies is typically better, just because you have a greater chance for success for your investors.
And let's say in our time, it's really kind of like getting to the point where, we're trying to navigate. And what's your prediction? How should companies behave when it's like some uncertainty, like flying around, and how should, well, let's say I'm a founder, right? So I have some capital for myself. How should I manage my money? Should I like now cut the costs and try to save as much money as I can, or should I expand?
Well, you always want to be cash efficient, so capital efficient. So I think if you haven't raised money, but you're thinking about it, you definitely want to keep your burn pretty low, because if you run out of capital, you're going to struggle with your business. But of course, you want to generate revenue to support the company. But yeah, it's always good to be lean early on, because as you raise capital, then you can really ramp it up. So if you don't have the money to hire full-time people, to spend a lot of money on marketing, et cetera, then you got to keep it lean. So I think it just depends on where you're at with the business. And if you're going to raise capital, then you can start ramping things up again.
And I would like to ask a couple closing questions.
Sure.
So, so what's the biggest risk today what I'm talking about, it's like we just started 2025, and S&P 500 just experienced one of the worst days since maybe 2022. So for those people who may, be somehow in fear or threatened by that fact, what would you say to those people?
Well, if your money is in the market, think of it as a long-term investment. So things will turn around at some point. So if you want to keep it in there, and hopefully it will turn around at some point, but I can't predict that, right? But this is the way the economy is. There's ups and downs. If maybe in the history of our country, you've seen we've gone up over time, but if you look at it every quarter, there's ups and downs. There's recession. So that's just the way the economy goes. So you have to be patient, depending on what your investments are, but it could be a longer term play, especially if you're in the public markets. But this is natural. Every 10 years or so, we seem to have a major up or down, but then every quarter there's always ups and downs. It's just how the economy works.
Every 10 years. So we had 2008.
That was a big financial crisis, 2008. Yeah.
14 probably. What do you think?
2008 was the Great Recession, but that was a big one. But then it went. I think we had like a 12 years of growth shortly after that, and then it went down. So then the pandemic hit, and we also had a lot of other things happening at that same time, and that accelerated everything. A lot of things were bad at that point. We're still trying to come out of some of that. And I'm not saying it's every 10 years, but it seems like it. Every 8 to 10 years, we have a major turn, like a recession happens. But again, some people would say we didn't have a recession recently either. So.
And what do you think about like dollar as a currency? Because do you think it will continue dominate the market and being the main currency on the market? Because so European currency is getting closer and closer. They've done pretty good. They had a pretty good performance mainly because of the Germany. And also China is kind of keeping up. Recently was a report that they got a lot of power in consumer, basically in their like ability of consumers to buy goods.
Yeah.
So what's like, I'm not asking you about predict, and we're not like trying to being those people who are saying some predictions for the future, but and telling people what to do. But how do you see that?
Well, I haven't really compared it to other currencies, but it's a pretty stable currency. It's backed by the government, pretty stable government, and so the dollar to me seems still pretty strong. So part of is there civil unrest in the country that maybe the dollar or the currency goes down in value, but I think in this country it's pretty stable. But of course we have ups and downs with everything.
So we're safe. We're good.
I think so. Some people are investing in silver, right? Because they feel that is a safe future for them if the currency goes down. So, but I think we're okay.
Yeah, it's good to hear from person who knows, like finance and economy. And I think a lot of people want to hear that today, that we're actually fine. And I think the same. I think we're good. All those people who are like trying to emphasize on that fact is just trying to get advantage of it. It's my personal opinion. So last question: if not investments, what would you do?
Probably start a tech company. So that's I work with founders all the time. So that's been a idea of mine. Maybe I'd start a company. I started a venture fund instead, but if didn't do that, I'd maybe start a tech company.
For young people who are seeking for advice, one life-changing advice that you would give to those people, what advice would be?
Well, I mentioned it a little bit before, but take relationships very serious. Build relationships now, early in your life. Those will be super important for whatever you do, especially if you want to start a company, having that network is pretty important to lean on, whether it's investors, advisors, potential co-founders, employees, whatever. It's super important. To me, that's been the biggest success, I believe, that I've created in my life is the network I built.
So relationships.
Relationships are key. Yes.
Is a key.
Yes.
All right. Thank you, Jason. Thank you for that conversation. I think people got a lot of insights, like young generation, maybe people who are older, who are trying to, invest and they're looking for some opportunities. Also, I think your advice that kind of struck me that when we were talking about how to pitch, how to get advice from those people, how to get the funds, I think it was incredible information that you can't really get anywhere else. And I just would like to remind our viewers that you can follow Jason and on LinkedIn, and also don't forget that they host events, right, each month, like incredible events. I'm actually thinking about attending, so probably gonna.
Great.
And so what I want to say, you guys, you can find all links below and follow Jason. Thank you, Jason.
All right. Thank you.
That was an incredible conversation.
All right.
Thanks.